What's up, tax fam? It's Davie here. Today, I want to talk about how the tax system works for Australian small businesses. But coronavirus has been getting really serious right now, and there are rumours that the Australian government is going to replace the Australian dollar with toilet paper instead. So, I figured that this time round, I'm going to explain how tax deductions work in toilet paper terms. So there are 5 components of the tax system. So the first one we need to talk about is basically how much toilet paper you've made. So that's your total profit for the financial year. And the second one that you need to think about is basically the tax rate. So how much toilet paper the government wants to take off you, but just a portion of your total profit. The third one is basically the tax you have to pay. That's your total profit that you made throughout the year times by the percentage that the tax office wants to take. So the fourth component of the tax system is basically how much tax you've paid up to date. So throughout the year, you would have given some toilet paper to the government already. So that's your tax paid. And the fifth thing is basically your tax refund or payable. So once you've worked out how much tax you've paid up to date and how much tax you need to pay moving forward, then you minus the two together and you'll get your tax refund or your tax payable. So let's get into the nitty gritty and explain how those 5 components work for your small business. So firstly, one toilet roll is going for $10,000 right now. So let's just assume that you've made 11 toilet paper rolls throughout the year, which basically means that you've made $110,000. For a company, your tax rate will be 27.5%, which means your tax payable is $30,250, which equates to 3.025 toilet rolls. And say throughout the year, you've only paid 3 toilet rolls or $30,000 in tax installments. So because you've already paid $30,000 worth of toilet rolls, you only need to pay $250 worth of toilet rolls for your tax payable. So now let's bring on tax deductions. So say that you had 11 toilet rolls in the first place, but now you decided to spend 1 toilet roll on your business expenses. Then this changes your profit. So your profit now goes down to 10 toilet rolls, which is $100,000. You don't necessarily get that 1 toilet roll back. You get what your tax rate is times that toilet roll. Now your tax rate stays the same at 27.5%, and that 27.5% will times by your total profit of $100,000. So as a result, your tax payable is $27,500, but you've already paid $30,000 of taxes throughout the year. So you should get $2,500 back instead. So that is your tax refund. So in the first scenario, if you didn't make the $10,000 deduction, you would have had $110,000 in profit. And then, as a result, would have paid $250 in toilet roll. But in the second scenario, you actually claimed $10,000 and only showed $100,000 profit, and then got a tax refund of $2,500. When you add the two together, you actually added to $2,750, and that's basically your tax rate of 27.5% for a company. So that's how much you actually get back when you spend $10,000 or when you spend whatever tax expense that you have for your business. So hopefully that makes sense, guys. Stay safe, wash your hands as regularly as possible, and use your toilet paper wisely.